So big news for European investors. SAP has just overtaken Novo Nordisk and LVMH to become Europe's most valuable company. This is particularly significant because traditionally Europe's top companies have come from sectors like pharmaceuticals, luxury goods, or automotive. So for the first time, we now have a tech company leading the pack, mirroring what's been common in the US. So over the last year, SAP's stock surged by over 40%. The main reason behind this incredible growth are the successful shift from business customers to cloud services and the strategic push into artificial intelligence. What else? Meanwhile, Novo Nordisk has struggled to maintain momentum due to uncertain developments in their drug pipeline, causing them to lose market value quite significantly. As we can see over here, in the same period, Novo Nordisk is down by over 40%, so quite a major correction over there. And the same is true for LVMH, another one of the biggest companies in Europe, down over 27% over the same one-year period. So some major corrections, while SAP has been absolutely booming. Now, SAP's rise in price is absolutely crucial because Europe has historically lacked a strong presence in the global tech market, especially when we compare to the United States, right? Having a European tech company at the top really symbolizes potential growth, innovation, and improved global competitiveness. And overall, when we look at SAP's revenues also, they have been growing very nicely as well. Of course, from 2020 to 21, there has been a little correction, but since then ramped up nicely with forecast expectations continuing to grow going forward. And even when we compare it to some of the US peers, such as Salesforce, Palantir, Intuit, Adobe, actually it's holding up quite well. You can see the market valuation, 317 billion, is actually more valuable than the absolutely hot Palantir right now, right? Or even more than Salesforce. So that's really refreshing to see a European company doing so strongly, at least when it comes to valuations as well. And that's even considering that Salesforce has higher revenues than SAP, 37.9 versus 35. Yes, of course, Palantir has significantly less revenues, but really huge valuations. So that's something to keep in mind. And also Adobe has less revenue than SAP has. And even in terms of profitability, I must say actually really not too bad. Their gross profit margins are 73%, while Salesforce is at 77% and Palantir at 80%. And if we compare it to the S&P 500 total returns, so including dividends, which SAP is paying, well, then even over a 10-year period, it actually managed to outperform the S&P by quite a bit, 233 versus 346, which also at the same time you would expect a tech company to do, right? That's the whole point of tech company, to hopefully outperform the average, because S&P 500 includes a lot of different industries and sectors, including some very traditional sectors. So that's not super surprising. And you can see, especially in the last few months, obviously, it got a major boost over here. So that's why when we go over the one-year period, it was up 42%. While the S&P is only up 12%. And yeah, looking at the dividend, they do pay out a very small dividend of 0.88%, which is again typical for tech companies because they reinvest a lot of their profits into further growth, which is good, right? Research and development, payout ratio of 50% is sustainable, means they can continue paying that going forward. And the 5-year growth rate, actually 7.39%. So that's actually a very healthy increase of dividends. However, one thing to keep in mind is the absolutely crazy PE ratio of almost 100. You can see that over here, 96.45, which for European standards is extremely high, right? Usually European companies have significantly lower valuations. And here it's very high, probably one of the highest I've seen in Europe. And that could potentially mean it's already overvalued, right? So the question is, how much higher can it go? We can look once again back to the US at Palantir, which has an absolutely crazy PE ratio of 173. So that's absolutely ludicrous in my opinion. But then again, 100 seems already very high, even when I compare it to the most valuable company in the world, Apple, which currently has a PE ratio of 30, so significantly less than SAP. And the high PE ratio indicates that investors have very high expectations of future growth, which might not be sustainable. So let's talk about some of SAP's internal challenges and the competitive landscape around them. So despite their market performance, internally SAP is seen by many as somewhat old school and clunky, and having friends working with their products inside and outside as customers, they can confirm the same, especially when we compare to the US-based competitors such as Salesforce, Microsoft, Amazon Web Services. SAP's offering appears less innovative and more cumbersome. Another concern is SAP's competitive edge, which ironically isn't about attracting new customers, but about making it very difficult for existing customers to leave. So instead of calling it the barrier to entry, which we normally have for technology companies, here some people refer to it as the barrier to exit. So while SAP certainly is a tech company, I really think it's a legacy tech company where I'm personally not really seeing the innovation, the drive, the AI that we see in some of the other US counterpart companies. Now, granted, they are benefiting, of course, right now from, European companies looking to SAP to have European sourced technology rather than making themselves dependent on US technology, for example, and of course other factors as well. But that is one of the big drivers, not necessarily because the technology is superior than other providers. It's also important to place SAP within the context of the German DAX index, which has been remarkably outperforming global markets. Despite economic struggles domestically, SAP alone is responsible for around 40% of DAX recent gains, with other notable contributions coming from Siemens Energy and Rheinmetall, a major defense company. So when we jump over to Financial Times, a great article over here where they actually talk about Germany's own Magnificent Seven. So it's really only a handful of companies. So the Frankfurt DAX is basically Germany's representation of the biggest 40 companies by market valuation. You can see it similar to the S&P 500 that really is an index representing the strongest companies in Germany, and that has risen by 18.7% this year alone. So major outperformance versus the S&P 500. And interestingly enough, the German economy is only about to grow by 0.6% in 2025. So those few companies have really outperformed the overall economic outlook of Germany itself. And yes, even for portfolio managers from JP Morgan, it has really been a surprise of how strongly those companies have been doing. And here we have some major stock exchanges from around the world, and that's 2024. So full year 2024, you can see S&P 500 grew obviously significantly, but then we have the German DAX that grew just shy of 20%. Then we have the topics from Tokyo, Japan that grew also almost around 15%. IBEX 35 from Spain, just shy of 15%. Then we have the UK companies with the FTSE MIB and FTSE 100, still growth. And the CAC 40 from France actually had negative growth, which of course is not really nice to see for investors. And I really like what they say over here. Technology stocks have been the story of the year. Of course, everybody wants to have tech exposure, right? But it's very true that they say in Europe, we only have two major players, ASML from the Netherlands and SAP from Germany. These are real, true tech companies that we have on the whole continent, which is quite sad to say. And that's a great chart with a nice overview of the performance changes in the DAX over time. So this is back in 2014, where we see the average weighting in percentage inside the DAX, where a company like Bayer, right, a huge pharmaceutical companies, and the red stocks are actually the biggest one in terms of weighting. We had Siemens, BASF, Allianz, and Mercedes-Benz. So at the time, SAP actually wasn't one of the biggest companies. It was big, but not one of the top companies in there. And then some other ones in there as well. And you see, none of them are real true tech companies, right? Mercedes-Benz is a car company, Allianz an insurance company. But then we move ahead by 10 years to 2024. And now you see the change over here, SAP now being the biggest one in the DAX, followed by Siemens, Allianz with Airbus, and then Deutsche Telekom. But still, Munich Re, another huge insurance company, one of the biggest player in there as well. So you can definitely see the shift over time. But yeah, looking at all the other companies, again, really lacking those strong tech companies. But of course, some investors, similar like they say in the US, they're a bit worried that we're going to have too much concentration at the top, even at the DAX, run by a couple of major players that have huge valuations, while the rest of the companies only contribute very little towards the overall gains of the DAX as such. And there's always the question whether you want to go for an equal weighted index or an actual weighted index, right? So basically, that's a differentiation of having each company inside of it, if it's 500 or 40 in the DAX case example, basically each of those companies has the same weighting. While if you have a weighted index, basically the more valuable a company is, the higher the weighting inside of the index. So that's something to consider. And there are different ETFs that you can choose to have an equal weighting or a weighted weighting, so to say. And obviously you can see over here also for the last few years, they both pretty much performed similarly. But now that we have those kind of Magnificent Seven emerging even in Germany, you start seeing the weighted one really outperforming because those companies have done exceptionally well. Which of course also on the flip side, why some investors invest into the equal weighted, because if those top companies were to do worse, then it would also underperform significantly, maybe the equally weighted one. But that might be a whole topic in itself for another video, but that's just something to keep in mind. The same you can do for the S&P 500, for example, where it's also weighted and unweighted ETFs available. So let's talk about Europe versus US investment outlook. Right now, Europe seems very attractive as investors diversify away from the US due to the recent uncertainties. But according to a recent Goldman Sachs report, the long-term trend still favors US markets. And interestingly enough, nearly 1 in 5 US stocks are owned by overseas investors, which really demonstrates the continued global confidence in American markets for stability, liquidity, and growth. They argue that the US market size and liquidity is more than 4 times the size of the Europe Stoxx 600 and 8 times bigger than that of China's CSI 300. And they even go on to say, despite the recent setback in prices overall of the index pulling back, they still expect S&P earnings to grow by 7% annually in 2025 and 2026, outpacing Europe's 4% and 6% growth in the same period. Moreover, the weakening dollar, which does make US stocks even cheaper for overseas buyers, which in return means more money and liquidity flowing into the US markets. But as always, with all these reports, they're always to be taken with a grain of salt. I mean, here we have a CNBC article, also from Goldman Sachs, published not so long ago, back in October 2024, where the same Goldman Sachs forecast just a 3% growth of the S&P 500 over the next 10 years. So there you have it. All those projections are just that, projections and forecasts based on most recent data. Nobody knows where the future is headed. And personally, while I'm very excited to see Europe's tech sector gaining momentum, I believe strongly in staying diversified and investing in long-term markets like the S&P 500. Europe's current surge is encouraging, but investors should remain cautious about the hype-driven valuations and instead focus on real innovation and robust fundamentals. If you enjoyed this kind of video and you want even more deep dive discussions, then definitely check out the Smart Money Club, which is free to join. We talk about all things money, investing, and personal finance. Next up, check out this video right here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao!